the record. All right. Good morning, Sam. How are you?
Good, Eric. How are you?
Doing great. How are things down there in Daytona?
Well, should we do a disclaimer for everybody that you have kids in the background and I have construction going on? So it's as real as it gets, brother. That's how real it is.
It is real life. You know what I mean? It's just, this is our office space. So I work from home primarily.
Yep.
And so if you hear the kiddos in the background, no big deal. We'll keep pushing through it. And then Sam, what's going on with
And if you
construction
see a
over where you're
ceiling
at?
falling down, just as long as it doesn't hit my head, I'll keep going.
What are you doing for construction?
They're just putting in some outlets for us. So,
Oh, very cool.
yeah.
Hey, so I appreciate your time today and this morning. So really what I wanted to get down to is, I know we talk a lot about the VA loan, but kind of wanted to go back before that. And just a lot of times I have first-time homebuyers calling me and like, hey, what's the process? Where do I start? Who do I talk to? And maybe we can dive a little deep into that and just kind of get somebody started. If somebody's looking at this video for the first time, just trying to get some information online. So let's go ahead and start with this question. So where do you think a first-time homebuyer should start? Should they talk to their friend's realtor, look somebody up, or should they talk to a lender first? What's that relationship look like? What do you think?
Well, whenever I explain it to anybody, Eric, it's more like, people don't go to the grocery store, put all their food in a basket, and then go to the checkout line and not have their money. So why would they shop for the most important, biggest purchase they'll ever have in their life without having their money set up? So personally, for me, I'd rather somebody get qualified first, just so they know their buying power. And just to make sure too, as far as a real estate agent, a professional real estate agent is not going to take somebody around without having some kind of qualification. So I think getting your money lined up and just getting your house in order type of thing is the most important aspect of it. And then, going to that realtor referral, somebody like yourself.
Gotcha. All right. That makes sense. So a lot of times we'll say that on the realtor side of the house, like, hey, if you're looking for, home, talk to your realtor. That way they can partner you up with lenders that they work with routinely. So it's interesting to hear your perspective on that. Okay, so let's say somebody comes and they're going to send them over to Sam. Sam's going to pre-qualify them. But before we get there, is there anything that they should look out for? Like, hey, is there a minimum credit score I should be looking at? Is there any type of like, man, I've got all this stuff backed up and I need to have this money saved? Like, what should I have ready to go before I talk to you? Or do I need to have anything ready to talk to you?
Well, the coolest part about what I do is that everybody's different. It doesn't matter if you're twins, they both live different lives. If you're a twin brother or sister, whatever it could be. So in lending, it's the same type of thing. Everybody talks about how, I went here and I did this. I went here, I did that. I said it earlier, having your house in order, the three things lenders look for is just credit, collateral, capacity to repay. So as long as you're paying your bills, sometimes there's hiccups that happens, you want to have explanations for that. With collateral, some programs you need money down, some programs you don't. You want to have some money in the bank. And lastly, as long as you have employment and it's something that we can verify and it's stable, as long as you're not trying to overbuy, it's definitely those things are the things that we're going to ask for. And I always tell people, it's like going to the doctor's office. The first thing you'll do is always fill out that basic information form. With that basic information, and when the nurse takes your blood pressure and temperature, they're going to be able to kind of go through very limited things. That's when the doctor comes in. And that's really when your mortgage planning session kind of happens.
Gotcha. And so do you have any numbers you can share, or is that just doesn't even make sense to share like a minimum credit score to get qualified?
I mean, it just depends on the loan type. I mean, if you're going with a conventional loan, you definitely want to be over a 620. If you're in a government range, meaning FHA or VA, I've seen people go down in the 580s up to, 800s. So it really depends. Because also too, Eric, you have to look at, any good loan officer in the country, they're going to look at the overall situation. Because what if you have a husband and wife, right? And let's say the wife's the main, or let's say the husband's the main, the wife's the main wage earner, right? The wife passes away suddenly of cancer. Well, let's say that husband, for a period of time has challenging situations. Those are called extenuating circumstances. So really, when you come to a lender, you want to be prepared, which what I mean by that is just have all the different things that you need as far as that credit, collateral, capacity. And if there's anything challenging in your past, just have an example of why, like what happened and, what did you do? Or what happened? What did you do to fix this? And how is it not going to happen again?
Gotcha.
So,
So you brought in an example of a husband and wife scenario. So a question we get quite often is that, hey, so let's say the primary uh, income provider is the wife here, but she
yep,
has horrible credit. The husband,
yep.
they're going to apply together. He's not working, staying at home with the kids, but he has great credit. How does that scenario work? Can they still qualify for a loan?
So normally every lender is going to go off the lower of the two credit scores. We get that question a lot with co-signers. Like a 19, 20-year-old kid wants to buy a house, mom and dad are going to co-sign. But let's say that kid, he got one credit card, forgot to pay it. His credit score is a 590, where the parents have an 800 credit score. We don't go off the 800 credit score. We go off the lower of the two. And that's most lenders do that. So unfortunately, we do get that question as well, where somebody that has more of a challenging situation has more of the income, where the other one doesn't. Unfortunately, it doesn't balance out that easily.
Is that something you still work with, or is it just kind of like a non-starter?
Well, it depends on the whole situation. I mean, if they qualify together with the lower credit score, then by all means, we'll put them both on. But yeah, it's case by case basis. That's what I think is so cool. Just like you go into houses, you can even have a bunch of houses that are in a row and they could all be the same model house, but they're all going to be different. That's the same thing with us in lending, is that everybody's situation is different. That's why, too, interest rates, and jumping on that for a second, everybody's like, oh, my neighbor got this, or my buddy got this. Depending on that person's overall situation, that's what determines interest rates.
Gotcha. Now that we're on interest rates, I do have a question on that. This is a question we get quite often as well. So I'm assuming you do as well. So somebody's working in the pre-qualification process and they're shopping lenders. They're like, hey, I'm going to go with A, B, and C. This lender here is offered, let's say, 3%. This lender is offered 3.25%, 3.25%, and this guy over here is offered 2.75%. But correct me if I'm wrong. I didn't think you can actually offer an interest rate until you're under contract. Is that correct?
Yeah, basically, there's a real rate and a stated rate. A
Okay.
real rate is a rate that if you called me, Eric, and let's say you and Katie find a house today and you're under contract. If you call those three lenders, whatever their fee basis is and whatever the rates are, that's what they can offer you at that point in time. If you call them tomorrow, congratulations, the world changes every day. And sometimes it even changes during the day. So until you're under contract, that is a real interest rate that person can give you, because at that point, they can lock you in and then that rate is protected. But just like shopping up front, like I always overestimate our rate just for qualifying purposes, because what happens if the market changes? So Eric, if you and Katie came to me and let's say I did your qualification at 3%, but let's say it takes 6 months for you guys to buy a house, rates go to 3.5. Well, that 3.5 difference in payment, makes it that you might not be qualifiable. Well, that's a problem. So we always go a little bit high just for, an estimate.
Gotcha. And then how long are those? So we were talking about 6 months. So how long is that pre-approval good for? I'm typically hearing anywhere between 60 and 90 days. Do you have a better number for me?
Yeah, normally, things have to get updated within a certain period of time. I always jokingly say to people, unless you decide to stop paying your bills, you go claim bankruptcy. If you're good now, you're probably going to be good in the future. Now, things you don't want to do is when you're qualifying for a mortgage, you don't want to go get a new car. You don't want to move money around in a million different bank accounts. Those type of things are really what kind of, I would just say it, throw like speed bumps, or let's call it turbulence during the flight. So you want to make sure your position when you first apply for that mortgage normally should stay the same. Okay. So to answer the question directly, because you did ask it, depending on your credit report, some credit reports expire in 90, some reports expire in 120 days. So as long as we update it, shouldn't be no harm, no foul.
So the driver is the credit report and nothing else other than
Pretty
that?
much. Well, documents still expire within a 60-day window. So now with COVID, some of those shrank down to 30 days for a while. It's unfortunately our industry, those guidelines are changing every day because it's like the wind. It's like politics.
Okay. So there's a lot of different factors and everything's driving. Yeah. It's not like, hey, it's set in stone, it's 60 days, set in stone, 90 days. It's credit report's a part of it, but it can be shorter or longer depending.
It is, yeah.
Okay.
I'm actually pretty sure it's 120 days for credit reports. So,
okay. Speaking of credit reports, so like, is it the same credit report that I pull up on Credit Karma? Is that going to be the same one that you guys pull up, or how does that work?
Definitely not. So this is how I explain it. And some people agree, some people don't. You know, Credit Karma, all those different credit sites, they're commercial sites that are trying to get your data so that other people can advertise to you and other people can solicit you for business. When you're coming to a mortgage company, they're pulling straight directly from the bureaus, and those bureaus are coming to them and their raw scores. And what I mean by raw score is that's truly what your credit score is, and that's what the lender will use. If your Credit Karma is 50 points higher, because it normally will be, that's just, you know, unfortunately, that's not what we utilize.
Gotcha. Now, is there a credit score that like, hey, you're above this number, it doesn't really matter? Like, because I guess the question that comes up with your credit score is that, hey, I don't want to talk to multiple lenders because I'm not, credit's going to get hit. I don't want to bring it down because then all of a sudden, maybe I could have qualified, but then because I kept hitting it down, I don't qualify. Is there any truth to that?
Yeah, so credit scoring is one of those things. When you have inquiries, they're looking for credit abuse. So like if Eric, you go out and you get a mortgage loan or you apply for one, you go get a car, a credit card and a personal loan, all within 30 days, you're kind of credit shopping for all different things and they're going to kind of ding you for that. Now, if you're going for a mortgage and let's say within a 2-week period, a couple people pull your credit, it shouldn't really affect you. Now, I have had times where people are like, my score went down 3 points. I don't know the rhyme or reason. It could have been the same exact time that maybe one of your other credit liabilities updated. But at the end of the day, if a couple of people pull your score, as long as you don't have challenge credit, if you have really challenged credit, then yes, an inquiry could be more detrimental to you. But if you're like a 700 or above, it's really not going to affect you. That's what I've seen over 24 years of doing this.
And that's what I've seen personally. Like whenever I apply for a loan, I'll see the hit, you know, but like within a month or so after everything kind of washes out, it goes right back to where it was at before.
And normally, just so you know too, lenders will ask like, why did you have that credit pulled? And the reason they do that is just because they want to make sure you didn't open up any new debt. So just be prepared when let's say you apply for a mortgage and then you're 20 days into it and that lender sends you a form saying, hey, can you explain to us why you had your credit pulled here? They just want to make sure, let's say you just got a brand new car and it didn't report on your credit report. Well, that's a debt against you. So they have to be clear that that hasn't happened.
Yeah. Now, since we keep talking about the car and the car loan and extra debt that comes in, I want to hit this question real quick. So when somebody we're under contract, we're about to buy the house and we're clear to close, is this a good time for us to go and buy a new car and put new stuff on our credit card, or do we still need to wait until we close?
You definitely want to wait till you close. Cars, I jokingly say, are killers of housing dreams because these especially younger kids will go out and get a $700 a month car payment. That takes so much buying power away from your housing opportunities, and cars really are, because their payments are so large. And I've just seen so many people where they'd have to sell their car, they'd have to have somebody else assume the car. So yeah, cars, and you definitely don't want to do it before closing, because here's the thing, they will find out. There normally is a soft pull, it's called, or it's a credit refresh. They do that just to make sure nobody has acquired any new debt. It's not a hard inquiry, so it won't affect your score. Like you're not shopping for new credit, you're just refreshing the credit you already pulled. And if something updates and it's negative, you know, they're going to find out.
So when do you guys do that soft pull? Is like right before closing, or?
Yeah, normally a couple of days before closing.
Okay. It's good to know, because I know a lot of people, you know, I've seen it recently where somebody thought, hey, we're clear to close. We're just going to wait a couple of days that week. And so like, let's say we clear to close on a Friday, then Monday comes around, like, let's go shopping. And they buy all the stuff from Rooms to Go. And
Home
then the
Depot,
next
0% financing, right?
right. And all of a sudden, like, hey, I didn't, or they went with their friend down to like some big sale, and then they pulled out a credit card with their buddy, and they're like, hey, they can't no longer buy a house because of that. So I guess there is truth to that. Quick question. Now, is there a difference between a pre-approval and a pre-qualification? Because we see those a lot as a realtor, that people will provide like when we're listing agents, we'll see somebody provide us a pre-qualification or pre-approval. Is there something that carries more weight? Anything you can provide on that?
Yeah, pre-qualification is basically a lender's opinion. So Eric, if you called me up and told me your credit score, how much you made and how much you had in the bank, I could tell you if you can get an FHA, conventional, or VA loan. Now, if I trusted the fact of what you're telling me, I can send a letter to your real estate agent to say, hey, Eric's pre-qualified for, you know, X amount of dollars. A pre-approval is everything that Eric just told me. He validated it with his pay stubs, his W-2s, and his bank statements. So that pre-approval is kind of like a blank check up to the amount that that person's approved for. Now, personally, for me, if I tell somebody they're going to get a mortgage, they're going to get a mortgage. Now, when I'm sending a letter out to an agent, I have no problem doing the pre-approval, pre-qualification. At the end of the day, any good loan officer, especially somebody who's been doing this as long as I have, you know, most of the time, the weight that you hold with regard to saying, hey, this is good to go, it's pretty much should be good to go. But pre-approvals, especially for out-of-town lenders, it's very important to have.
Gotcha. And then, so as somebody's looking and watching this video and kind of getting a little bit more information on the whole home buying process, when should somebody start the process? Is it 30 days? Like, hey, I need to be in a house in 30 days. Should I start like 3 months? Should I start a year out? It's a very common question we get. I'd like to hear your perspective on that.
Yeah, I'm more, you know, if you're about 3 months out, I would take a look at it, because 3 months actually gives you that buffer too in the event. So not saying, I'll just say it the truthful way. So let's say you got $10,000 in cash sitting at your house. Well, the fact is that if you just go put that money in the bank, it's going to have to be there for at least 60 days, right? So that 90-day window, you know, we can kind of see that screenshot of everything. And in the event that anything has to change, or even credit challenges, if you have a credit challenge, or you have a credit report that has what's it called, disputed accounts on it, right? Those are things you can start working on, so that when you do finally fully apply, those things are taken care of, so that your buying process is much smoother.
Gotcha.
So,
Now, somebody that's starting off the buying process again, maybe from the past, like they have we'll go maybe through the couple of them. So let's say they have a short sale on their record. Is that something that's going to affect them when they go through the pre-qualification process again?
Oh man, this is like a mortgage test 101. So no, so it depends on the mortgage product. So like a VA loan, it's only 2 years. Where FHA loan is 3 years. Fannie and Freddie have shorter terms. It's 4 years for a short sale. So
how about a foreclosure?
Now foreclosure, it's a little bit longer. So I mean, VA is 2 years, FHA is 3 years. I believe Fannie and Freddie is still 7 years for foreclosure. I could be wrong though. For some reason, it's something in my brain saying they had an update, but I can check on that. If somebody has a question, they can reach out to us.
Okay, perfect. Yeah, because that's a lot of
oh wait, stop. Very important. Very. This is hugely important. If you do unfortunately have that in your past, right? You want to make sure the date that the deed transferred out of your name, that date, you have to know that date. The reason why is, I'll give you an example. I had a gentleman that in 2010 had a foreclosure. He came to me in 2018 or 19 to get a VA home loan. So that's 8 years, right? So even on the old application, he didn't even have to list that he had a foreclosure in his past. Well, what happened was the Bank of America, they didn't record the deed or transfer the deed up until like 2018. So that's the date that the 2-year period starts. So he lost 8 years of his life because that bank didn't transfer the deed. So what happened was, it was a mistake. Honestly, I'm human. I made a mistake. I didn't have to ask the question because it was over 7 years ago on the application. It was in 2010, and common sense says it should transfer within a year or two, and he was well beyond that. Well, it snuck up, and unfortunately, he couldn't get a mortgage for a little while. So the deed transfer date is everything. If you have a short sale or a foreclosure in your past, that is a date that everything starts moving forward. As far as your, like, call it your recovery. Your recovery time starts when that deed transfers.
And so who do they need to talk to make sure that happens?
I just check with your county courthouse to see that, you know, the old house that you had is transferred. So, and we have ways to look it up too, depending on the county, but that is something we can do.
Wow. Okay, so now that we've gone kind of through the whole pre-qualification process, we've talked about credit and collateralization and make sure your ability to repay, and we kind of go through, you start working on the pre-approval or the pre-qualification. I'm assuming they're going to have a conversation with you like, hey, you're pre-approved for $400,000, but I only want to spend $1,500 a month. Is that something you can work with them on?
Yeah, the only thing that really throws that off ever is taxes and insurance. So we can give them a baseline number of what a payback would be of the money they're going to borrow. and then they just have to account for tax and insurance, which we'll help them with, but we just back that out. So if it's 1,500, if the average taxes for a $400,000 house are 3,600, we'll back off 300, back off 100 for insurance. So you're really talking about $1,100 a month mortgage payment. That would equate out to, based off interest rate, term, however much money.
Okay, so you have that conversation with them. So like, hey,
Yeah.
this is how much house you can afford, but this is actually what I want to afford.
Yeah, and we'll normally qualify somebody for a little bit more because everybody goes and you say 400,000, but they find the one that's 409.
Yeah. Hey, I'm the same way. I'm a shopper too,
Yeah.
Okay, so now that we've gone through the pre-qualification, we've got the letter, and we find a house. Are there any fees that I should be looking out for and maybe associated with the loan? Like, well, maybe we'll go through VA, FHA, and conventional and see what the difference is. So for VA, are there any fees associated with that loan? Because I know it's a zero down product.
Yeah, we don't charge any fees as far as us as a lending institution. Other organizations sometimes do charge, up to 1% are allowed to charge. There's obviously third-party fees, things like doc stamps and transfer fees, also title insurance. With FHA, some lenders charge fees depending on if you serve in our community or country. We don't charge fees. Normally, the lender fees can be anywhere from $1,000 to $1,500. Same thing with conventional or FHA and conventional. So. But yeah,
now, are those fees regulated, or are they just kind of like whatever the lender wants to charge?
Whatever the lender wants to charge. Other than VA is up to 1%.
Wow. So definitely want to make sure you're comparing apples to apples when you're like talking to different people.
That's why it's easy with us. If you serve in our community or country, our fee is a whopping 0. It makes it easy.
Wow.
So.
Okay, so how about like a VA loan? There are some things like a VA funding fee.
Yep.
Now, what is that something that gets rolled into my closing costs, or how does that work?
It's not rolled into your closing costs, it's rolled into your loan. So you can pay it out of pocket if you want, but traditionally 98% of veterans will actually roll it into their loan. So if you have a $200,000 house, let's say, and your first time use, which is 2.3%, you would be borrowing $204,600.
Okay, so you just rolled it right back into the principal. Yep. Got it. And then is there something?
VA, I know we didn't want to talk too much on VA, but just real quick, VA, it's not a loan that you can roll everything into it and get into the house for nothing. That has to be negotiated up front. So that's where, your good real estate agent like you are, Eric and Katie, that you guys can negotiate to see if the seller can pay those costs. But there still are costs associated with VA home loan, but those can be negotiated that the seller can pay them.
And then you're talking about closing costs, right?
Yeah, closing costs.
Gotcha. And do you know what closing costs from? Like, do you have an average or like?
It's like 3 to 4% in the state of Florida.
Okay.
Yeah.
That's what we're seeing too. So 3 to 4%. So that's kind of something we balance out. And you know how this market is right now. It's really tough to have sellers do anything right now because they don't have to, because there's a ton of buyers right behind them. So we're recording this in the end of 2021. So if you're watching this in 2022 or further, it may be different then, but this is the state of the market right now. How about FHA? I know there's something called maybe an upfront mortgage insurance premium, something like that.
Yep. So FHA charges a 1.75% upfront mortgage insurance premium. But again, you can roll that into the mortgage, so you don't have to pay it out of your pocket. But there is a monthly premium you have to pay with FHA, which is 0.85% of the loan amount.
And what's that premium called?
Upfront, well, it's mortgage insurance premium. It's the same thing as PMI for conventional loans, private mortgage insurance, but FHA calls it an upfront mortgage insurance premium.
Got it. And then does conventional loan have any type of fees like that? You just said
only
PMI, right?
If you're not putting 20% down, there's PMI associated with it. And that's based off credit score. The better your credit score, the better everything is. So
and what's the like the bottom of the top of the credit score? Like, is it for some reason 760 is clicking in?
Is expensive. Yeah.
Okay.
Yeah.
Perfect.
So listen, we got to save some questions for next time, buddy. You can't ask them all in one sitting.
Well, no, I'm trying to. So we're blasting through a lot of first-time homebuyer type questions because I got a couple more. If you got a couple more seconds. Okay. All right. So VA. So let's say somebody has a ton of cash saved up. They're a veteran. They're serving in the military, but they're like, hey, I don't want to pay the VA funding fee. I can put 20% down. Do you have a recommendation of what they should look at, conventional versus VA?
That's where I have to do an analysis to see what makes more sense, because VA interest rates a lot of times are a little bit cheaper. So I'd have to look at exactly how that would roll out over the long term. And that's where a good mortgage planner comes into play like we are.
Gotcha. I know we didn't want to do much VA, but quick question on VA. Is there like a limit on how many times I can take a VA loan out?
No, sir. There is a zero. You can take as many VA loans out as you want. Normally, you can only have one at a time. Sometimes you can have two, but there's a lot of disclaimers that go into that, which we'll go into on our VA call that we're going to do soon.
Yeah.
Part two, round two.
Part two. Yeah. Now, closing costs. Did you say we can roll those into our loans or no?
No, you cannot.
Is that for FHA conventional and VA straight across the board?
Yeah, you can negotiate that the seller pays part of them, but that's where negotiation comes into play.
Because we've heard that other lenders, what they'll do is that they roll. Okay, let me back up. The first time home buyers rolling in 2021, they said, hey, yeah, my parents did that, or my friends bought a home a few years ago, in a few years, maybe 10 years, right? Like, yeah, they didn't have to pay for anything. Their lender rolled in all their closing costs. Is that something you guys used to do back in the day, or is that just bad misinformation?
No, it's just, yeah, it's bad information, because what happened is the seller negotiated, they paid it. And what happens is they just say that the lender rolled it all in, because technically it does go into the loan amount. Because in theory, if somebody rolls in $5,000 of closing costs, normally you can get the house probably $5,000 less than. It's just that you're upping the price by $5,000, so the seller's not losing that $5,000. So, and if that confused anybody, just call us and we can explain it. Because it's frustrating, because people do think that I'm a veteran. I thought I didn't need any money. Yes, it's 100% financing. You buy the house for dollar, but there's still external fees that are associated with buying a house that are required to be paid.
Right. All right. I think my last question is going to be, they just recently, in 2021, updated the conforming loan limits. Can you tell me a little bit about conforming loan limits? What is that? Which loan product that applies to, and what they are?
So conventional mortgages right now, and possibly FHA and VA, are going to change up. But the conforming loan limit, and Eric, you totally put me on the spot. It's like 645. I know I should know this off the top of my head, but it jacked up.
Hey, Sam, you always ask me to put you like, just like,
know, man.
So the thing is, like with Sam, just for you guys are watching, like none of these questions are pre-planned. He's like, I shoot better just right off the top, so just fire them at me.
But that's when I actually haven't programmed in my head yet, but it's like 640 something, I believe, in our area. So it's high. It's over $100,000 more than it used to be. So that just shows you how much appreciation has been going on in the country.
And what does that mean? What does a conforming loan limit mean?
So it just basically means that lenders feel comfortable that Fannie and Freddie basically say under that limit. Actually, if you really want a history lesson, Fannie Mae and Freddie Mac, like I just got off the phone with them recently, and they said their government mandate is really to help moderate to low income families. Because I had a situation where a person had over $1 million in the bank, and we were trying to do something with income because she wasn't of retirement age yet. And they're like, no, Fannie Mae and Freddie Mac are set up for low to moderate income. And I'm like, so you're basically saying if somebody has money in the bank, you're really not meant for them. Anyway, long story short, that conforming limit is what they feel comfortable lending up to, as far as, being the entity that kind of insures it. If you go over that, that's where jumbo loans come into play. Now, the cool thing, I know, again, the VA thing, VA doesn't have any of those limits. There's no jumbo numbers for VA anymore. So VA is actually one of the best jumbo products in the world. But yeah, that's what that is.
So, okay, you kind of piqued my attention, or like my interest there. So with the VA loan, let's say a veteran wants to buy a $700,000 house. You're saying that no problem?
No, well, they still have to credit qualify.
Oh,
they can
yeah.
go actually. If their credit score, for us at least, if their credit score is under 700, they can go up to $1 million. If it's over 700, they can go to $1.5 million, 0% down. And if they have a service connected disability, there's no funding fee. So it's the best jumbo financing in the world.
That's unbelievable, which is awesome. It's thanking our veterans and service members for what they do. But 1.5
Eric, I'm
million,
doing the thing that most people shouldn't do on a podcast, because I'm frustrated that I totally messed that up.
Are you looking up the 645?
Fannie Mae conforming limit, because I told and 647 200. I know I said 647, but it's 647 200.
Perfect. Hey, you'll remember that today.
That $200. I mean, that $200 is going to throw it over the edge. So
Oh man. Well, I think we did like a quick rapid fire on that on the loan stuff. There's a lot of questions I get all the time. I appreciate
Yeah.
you bringing some clarity to all these things. I know as we get more and more questions come through, if anybody has any questions, we'll go
Yeah, just
ahead
reach
and
out.
we'll put them down in the comments below or something like that. Sam, how can people get a hold of you?
They can give me a call. I'm sure you'll put the phone number below, but 610-703-5626, or they can go to heroesfirsthomeloans.com.
Perfect. How about on social media? Do you connect with people there?
Yeah, everywhere. You know
Everywhere.
us, man. We're all over the place. Instagram, Facebook. I don't do TikToks or Snapchat yet, but
Not
you
yet.
know,
But you got some
I,
team members that do.
I know I'm too old school, man. I'm old now. I was a young guy in this industry 24 years ago. Now I'm like the senior guy.
Yeah.
So
Well, appreciate it. So just so everybody knows, this is Sam Royer with Heroes First Home Loans. He's been doing mortgages for over 24 years. He's a Marine Corps veteran.
yeah,
So thank you so much for your service.
yeah,
He's
you
doing
too.
this awesome thing with the Helper Act. He's trying to pass some legislation. That way all heroes can get access to a loan product that is very similar to the VA loan. Can you tell us a little bit about the Helper Act while we have you here?
Yeah, so basically police, fire, teachers, and EMTs, when the bill passes, they'll be able to have 100% financing and no monthly mortgage insurance, just like we do as veterans. Now it'll be an FHA product, so it'll have the FHA loan limits, but other than that, it's pretty much like a VA loan. So, and right now it's in the House of Representatives for the US House. It's also in the US Senate. And yeah, got a lot of traction for it. We just got 2 other congressmen on yesterday. I got a call after this with another one. So yeah, things are rolling, man.
That's awesome. Well, thank you so much for what you're doing for the hero community. Yeah, this is awesome. It's really great to see how you're really making an impact and
if
putting
they
yourself.
if somebody really wants to look at it, the helperact.us.
Okay,
So that's
helperact.us.
Yeah.
Is it the Helper Act or just Helper Act?
Just the helperact.us.
Okay, perfect.
Yeah.
All right, we'll make sure we put that down. And Sam, as always, thank you so much for your brilliant
brother.
mind and for everything you do.
Yeah,
and we'll catch up soon.
All right, man. Have a good day.
Thank you. You too. Bye.
See ya.